This is part 3 of the video series for course 201, Building Statistical Arbitrage Trading Strategies. And in part 3 we talk about silver futures markets and listed calendar spreads. And this is a bit of a bonus here for the course 201, as we don't touch on silver much in the Building Statistical Arbitrage Trading Strategies book that is focused on market making for Bitcoin and gold futures markets. But to show the flexibility of the strategies being taught, we're going to bring in another market, silver. It's a precious metal in CME metals markets and very active contract. So let's dive in. But first, the disclaimer: everything discussed in this video and all content on marketmentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. Despite the fact that we don't talk about silver in the Building Statistical Arbitrage Trading Strategies Bitcoin and gold futures markets, we do touch on it just a hint in the digital gold book, where we compare the relative volatility between Bitcoin and gold and Bitcoin and silver. So you see in the top chart here, we look at the relative volatility going back to 2015 between Bitcoin and gold, and Bitcoin at the time of this chart, which I believe was in May of 2020, was plus 4,031.33% from 2015 levels, while gold was plus 47.23%, and then down below we see the silver mark at plus 10.77% since the same time back in 2015. And again, these charts were created in May of 2020, so the pricing is a bit off from where we are present moment and going forward. So let's pull up the simulator for building our trading strategies and learning how to design these types of systems. And we are going to have the gold markets on top here, and I'm going to bring in, or excuse me, the Bitcoin markets on top here. I'm going to bring in gold markets below, and the reason I'm doing this is we are going to discuss some similarities in the silver futures contract markets to both gold and Bitcoin. This is going to be GC VZ. We're going to put up the December market here for gold, and then we'll pull up the listed calendar spread for gold VZ. Go into spreads here and take a look for OCDs. There it is on page 3. Alright, so now we have our Bitcoin futures outright markets for August SEP and the AUG SEP calendar spread. We have our gold markets for OCDs and the OCDs calendar spread. Now let's pull up silver, which is a market we have yet to take a peek at, and let's see what's going on in the silver markets. So the product code for silver is SI, and we're going to open up the UZ calendar spread, or UZ outright, September outright market, Z December outright market, and the UZ calendar spread for silver. So here will be December. Side D's. Okay, now we need to figure out some screen management. So I'm gonna stick the algorithmic execution portal in the corner there, just so we can really get a view of all of these markets simultaneously. Now let's pull up the silver calendar spread for SEP-DEES. SEP-AC. Here we go. Here's our SEP-DEES market. So to bring it all together, we are looking at three different futures market complexes. We have the Bitcoin futures markets for August SEP, AUG-SEP calendar spread. We have the gold futures market outrights for October, December, and the listed calendar spread, AC-DEES. And we have the silver outright market for September 2020, the silver outright market for December 2020, and then the silver listed calendar spread for September, December 2020. If we look closely at this silver listed calendar spread, we will notice that, and this pricing needs to, we will notice that the spread is moving in increments of 1. That's going to be 1 basis point per tick here. And if we look in the outrights, we notice that the silver market is moving at a full point. So the calendar spreads are trading at a reduced tick to the silver outright markets. And this is similar to the Bitcoin calendar spreads, which are reduced tick and are trading at a reduced value from their correlating or corresponding outright markets. In Bitcoin, the calendar spreads that are reduced tick trade at increments of $1 relative to the outright markets that are trading at increments of $5. And we look down here at silver, and we also notice that the calendar spreads are trading at a reduced tick relative to their corresponding outright markets. So we can notice that if we're going to make a market in silver, we're only going to be able to trade at nickel prices, 240, 235, 230 up here, 245 to the downside. We're not going to be able to make markets synthetically in the outrights at prices in between the nickels, and this is very similar to what we discussed in part 2 of this video series in the Bitcoin market making overview. And if we now look at the gold outright markets and also listed calendar spreads, and we compare them to the silver outright markets and listed calendar spreads, we notice they are both in contango, where the near month is trading at a discount to the deferred month, or the deferred month is trading at a premium to the near month. And Bitcoin is also in a contango structure, but we know Bitcoin calendar spreads are priced unconventionally. So the relationship here between gold and silver is that the calendar spread markets are priced in the same conventional manner, where it's leg 1 minus leg 2 equals the listed calendar spread. For silver, SEP20 minus DEES20 equals the SEP-DEES calendar spread. For gold, leg 1 October 2020 minus leg 2 December 2020 equals the listed calendar spread. So this is why I wanted to bring up all three of these futures markets and show some of the similarities and differences, and take a peek at two different reduced tick calendar spread markets, and also two conventionally priced calendar spread markets, where the contango markets are going to be negative, and backwardated markets are going to be positive when it's leg 1 minus leg 2, as opposed to Bitcoin, which is an unconventionally priced calendar spread market, where it's leg 2 BTC SEP 20 minus leg 1 BTC AUG 20 equals the listed calendar spread. So silver has a relation has shares a commonality with gold markets, and also a commonality with the Bitcoin markets in two different ways. Which is interesting to point out, and just also shows the flexibility of market structures, and the importance of understanding contract specifications, and really understanding what you're trading at a fundamental level. And this also brings confidence to a trader. The more they understand what they're trading, the product, or the market structure of the product, would be a better way to say. The more confidence one is going to have in execution and understanding what's going on, and also in overall market analysis, being able to understand the calendar curve and the internals of market structure. So this is a good point to get rid of our gold markets and get some screen space and talk about reduced tick calendar spread arbitrage. And we can discuss this with both Bitcoin and silver. So I'm going to get rid of my gold markets, and I'm going to bring my silver markets below my Bitcoin. And unless I can bring them to this would be helpful if I could bring them to the right. I just don't know if there's enough screen space. I'm going to condense these markets. That makes it maybe a bit more challenging to see, but hopefully this will be helpful. Okay, so now what we're looking at here is Bitcoin futures markets and silver futures markets. This is the BTC AUG 20 outright market, BTC SEP, BTC AUG SEP. Here's our silver SEP 20 outright markets, and this is misplaced. Silver December outright market, and our silver SEP D's listed calendar spread. So let's put these into place. Let's even them up for good measure. And now I'm going to bring up the gold or the Bitcoin algorithmic execution portal. Let's see where let's launch this. This is going to be our leg 1 AEP for Bitcoin AUG SEP market making, and here is our leg 2 for BTC AUG SEP market making. And what we're going to do here is also create a market for silver, an AEP for silver. And I'll just throw in some orders off the market to work. So we can start providing liquidity to Bitcoin futures markets. Bid 95. So now we see we're working offers and bids in both the BTC AUG and BTC SEP markets. Things are starting to move. I might widen out just in case a sweep occurs and we get some really good fills on the spread. And while we're waiting to anticipate some excellent fills, let's go ahead and build our silver leg 1 and leg 2 algorithmic execution portals. So this is going to be silver SEP D's 2020 leg 1 AEP, and we're going to say silver SI SEP silver D's 1-to-1. We're good there. Multiplier, we're good there. We're going to quote in leg 1 on this market, and we're going to hedge in leg 2. We don't need we're good on the math, as we can see here. I'm going to go ahead and save this and launch. Let's find it in our list. Let's launch this in a trader window. Drag it over to our silver markets, and we can widen this out just a touch. And let's create one more for silver. Let's do the leg 2 algo here, SI UZ 2020 leg 2 AEP, and leg 1 will be silver SEP, leg 2 will be silver DECE, and we're going to quote in leg 2 and we're going to hedge in leg 1. Everything else checks out. Let's save this and launch. Now I'm going to drag this thing back into the corner. Alright, so in front of us here we have 6 markets. We have a Bitcoin AUG outright, a Bitcoin SEP outright, a Bitcoin AUG SEP listed calendar spread. We have a silver September 2020 outright market, a silver December 2020 outright market, and a silver SEP 20 DECE 20 reduced tick calendar spread. And now let's think a bit about reduced tick calendar spread arbitrage. We have already identified interesting theoretical statistical arbitrage in market making via the outrights and being able to lean against bids and offers in calendar spreads for Bitcoin. And as you can guess, the same principles apply for silver. We can make markets on the bid and the offer in both outright markets that correspond with the listed calendar spread, and we can synthetically attempt to make those calendar spreads, and in doing so we provide liquidity in the outright markets. What we want to discuss now is execution arbitrage upon a successful fill. So let's look at Bitcoin to start. And with Bitcoin we see we have a one lot bid at 102. So if I, as a market maker, want to bid 100 on the calendar spread, I can bring my bids up here and bid 100 synthetically. So you see my bid moves up in September and my offer moves down in August. Now I'm working to bid 100 in the BTC AUG SEP listed calendar spread, and this is a reduced tick market. So since there are bids at 102, if I get a successful synthetic spread in the outrights, buying September and selling August, or selling August and buying September at a relative value of $100 per contract, I can immediately sell this into this resting bid at 102 to lock in a profit of 2 reduced ticks. And in Bitcoin's case, it's $5 per tick. So this would be a P&L of plus $10 per contract that I can sell. Now there's only one bid left here to sell into, so I could still work 100 and sell into 102 if I get another good fill. But now the bids will be gone at 102 and the arbitrage gets squeezed. So now the next arbitrage here is if I get filled at 100 through a successful fill synthetically in the outrights, I can sell into the bid at 101, and I can capture a spread of one reduced tick, which would be plus $5. But let's say I don't want to work for plus $5, so I might continue to work 100. If I get 2 more successful fills, I will take out these bids, and then I might even begin to work 105s on the offer and begin to look for these bids to either minimize, or I might even try to start selling into these bids aggressively and begin to work 95s. So now I'd be, maybe I'm short a bid on the market. Maybe I'm short two as a position. I'm willing to kind of take that approach, and now I can back my bids up, which I've already done in my spreader, and I can start to work 95s as long as the market doesn't refill new bids at 100. And as long as there's no bids at 100, I can start to work to buy 95 synthetically through the outrights, and then at that point I can sell 99s as there's a one lot bid there. And if I buy 95s and sell 99s, I'm taking four reduced ticks as profit. One tick, two ticks, three ticks, four ticks. And you take 4 times 5, that's a $20 profit from buying 95s and selling 100s. So and this can be, then I can bid this thing back up, and bid 100s, and now I'm working to sell 105s, and now I'm working to buy and sell at 105 and 100, and that's a $25 P&L on a round turn because it's 5 ticks. 1, 2, 3, 4, 5. So that is an example of how traders can use these nickel prices to create executional arbitrage on successfully completed synthetic spreads in the outright markets for reduced or against reduced tick calendar spreads. And taking that idea, we can go over to silver, and we can take a peek at the outright markets and see where the price of silver is for September 2020, where it is for December 2020, and we can see what the relative value is. So silver DEES 2020 is trading 23.7 cents above silver September 2020, and we can come down to to our AEP for silver, and we can begin making markets and providing liquidity to the silver outright order book on the bid and the offer. And what we're doing is we're seeking to synthetically create the silver calendar spread at nickel prices. So if I look at the order book right now for silver, I see minus 0.238 bid for 177, offered at minus 0.237, 84 contracts on the size there. And what that signals to me as a reduced tick calendar spread arbitrage trader is that I can offer 0.235 and I can bid 0.240 in the outright markets synthetically through an algorithmic execution portal. And I now have, let's see, on the bid I have I have two reduced tick executional arbitrage on any completed spreads on the silver SEP DEES calendar spread at minus, if I'm bidding minus 0.240. And on the offer, if I look here, if I'm offering minus 0.235, I look how many reduced ticks I can take from the best offer in the book, and it's one, two. There's two reduced ticks I can take on this spread. So as a reduced tick spread, these silver outright markets, check the contract specs, they trade in $25 increments per tick. So the reduced tick calendar spread, just like Bitcoin, trades in $5 increments per tick, as it's a reduced tick spread. And that means I have $10 of executional arbitrage on the offer in the calendar spread, and I have $10 of executional arbitrage on the bid in the calendar spread. And I can work synthetically both the bid and the offer through the outrights to a round turn that would equal 5 ticks, or equal the full tick value of the outright market if I were to buy at minus 0.240 and sell at minus 0.235. So to grasp this, let's put some orders in the book, and let's bid minus 0.240, and we see an offer populate in the silver DEES outright market on the best offer in that outright, which is pretty lightly liquid. And so this is providing a service to to market participants as well as the exchange. And we can also offer this spread at minus 235 and you'll see a bid populate in the book, and that's joining the best bid in the silver book as well. So that's that's again providing a service to both the exchange and to other market participants. And when you provide a service, you should get rewarded. You should get paid. And that's what the idea of providing liquidity in these markets really is. And so let's see if we can get. We got a round turn there, so we got filled on both of those orders. So that's a $25. I mean, this is just simulation trading, and we're not optimized, but that's how market makers get compensated for posting orders on the best bid and the best offer in illiquid calendars or in illiquid outright markets. And we can there's another fill. We just bought 240s, so I'll show you how I can come to the listed calendar spread here, and I can sell minus 0.238, and there I just sold minus 0.235 in the spread. But by selling 0.238 when I bought 0.240, I locked in $10 of profits, and there you see we just got short again from 0.235, so I bought 0.237, and just like that, we are already in the money. It's just arbitrage. I took 2 ticks on the position. So that is the overview of executional arbitrage in reduced tick calendar spreads for both Bitcoin and for silver. Hopefully this is helpful. This type of information should be invaluable in trying to understand market microstructure and arbitrage opportunities in futures markets. Thank you.